Hey folks, Dan Frio here with your closing bell for April 11th, 2025. So we're going to go over why mortgage rates spiked like they did. Look at the adjustable rate mortgage. It's higher than the fixed rate. That's insane. But we're going to try to make sense of why the market's up 600 points, why the bond market, well, it's recovering a little bit. Oh, hold on, let me refresh this because this thing is going probably bonkers behind the scenes. Let's look at our active windows. Let's see what the market's doing right now. The MBS market is down 15, so that means mortgage rates are continuing to go up. We had some numbers come in from the on the economic calendar that we have for this week, and it actually showed inflation coming down more than analysts expected. So why is this all taking place? Well, that's what we're going to try to answer in today's video. So my name is Dan Frio, where I do this report actually 2 times a day to inform you guys what's going on in this arena. We focus in on real estate, but this all plays a role in everything that you're going to do. And what we try to focus here in on is the financing of real estate, because I'm actually a mortgage loan officer. I'm federally licensed. I'm licensed in all 50 states as well as Puerto Rico. I'd love to be able to assist you if you get to the point where you're looking to buy that first house, maybe buy that first investment property, or maybe looking to refinance. Well, you should have done it 2 weeks ago when I told you to, but at these rates, you might want to hold a little bit, but check in. You still might be able to save some money there. But we're going to try to talk about today is we had inflation numbers come out. Let's get over to the headlines that we're seeing right through here. Dow Jones jumped 600 points. White House optimistic about a China wants deal on the tariffs. But if you dig down to the numbers, we're going to look right through here. There's a lot of information that just came out recently, and it's getting the little captions down here, but this would have been complete headline news if this was out 2 weeks ago. Let's look at the inflation numbers. We had wholesale prices actually go down. If we go to our economic calendar, well, let's go over to Rick Santelli and get his take on the market. Well, let's go over to here because I already have him queued up over here, because if we go there, it's going to show you some commercials. So let's get over to Rick Santelli. Let's have him give you all the information on the inflation numbers that we got today. Now, today what we got is producer inflation. So the thought is producer inflation then rolls over to consumer inflation, then rolls over to us. So the producer inflation, what's it doing? Because we know tariffs are going to be inflationary. How long they're going to last, nobody knows. But we know they're going to be temporarily inflationary. So is our inflation numbers coming down? Are they coming down maybe even more? We got energy down quite a bit. And we got other things down quite a bit. So could we actually be driving down inflation further than we expected? And then the tariffs maybe not make as much effects on the markets. That's my thought on some of these. Maybe sometimes I look at the glass half full maybe all the time, where most people look at it as half empty. So let's get over to Rick Santelli, get his take on this. You're going to be surprised at a lot of these numbers that he's coming back with. So Rick, take it away, buddy.
We're just seconds away right now from March PPI data. I want to get straight over to Rick Santelli. He is standing by at the CME in Chicago. Rickster, the numbers.
Yes, these are our March read on producer price index, the more wholesale side of the inflation equation. And they're big numbers, down 0.4 on headline, down 0.4. That would be equal to where we were in October of 23. And if we find a lower number, you're going all the way back to April of 2020 in the COVID-affected era, and that was down 1.2%. Now let's strip out food and energy, down 0.1%. That equals where we were in February. It equals where we were in July. To find a lower number, you're in April of 2020 at minus 0.3. If we look at ex-food, energy, and trade, it is up 0.1, also much less than we were expecting. Up 0.1 equals where we were in November of last year. To find a bigger, smaller negative number, you're minus 0.8 in April of 2020. Now let's look at year-over-year final demand, 2.7, well below our expectations of 3.3, well below 3.2 in the rearview mirror. To find a lower number, you're in September of last year. So we see that this metric had been moving up. Now it's moving back down. If we look at food and energy from a year-over-year perspective, 3.3, less than 3.4 in the rearview mirror, less than 3.6 expected. That equals September of last year. To find a lower number, you're in August of last year at 2.8, and drum roll, please, the last metric of this PPI data series, year-over-year ex-food, ex-energy, ex-trade, 3.4, the only metric higher than we were expecting by 0.1, higher than the rearview mirror by 0.1, 3.4 equals where we were in January. To find a higher number, you're in Dece of last year at 3.5. Late revisions coming in on headline. Last month's 0 on the final demand headline now moves to a positive 1/10, and it's now minus 4/10. That means the net change is a 0.5% lower. And on the ex-food and energy month over month, minus 110 becomes positive 110. So the net change is down 0.2 because the current number is down 1/10. Maybe the biggest thing that should jump out at anybody is that last week, a 2-year note yield closed, get this, at 366. It's at 383. A 10-year closed at 4% last week. It's at 442, up 42 basis points. Think about the ramification. We're at 60 on the 2-cent spread. Now, everybody's hair is on fire for all the uncertainty. I understand it. Hearing all the guests say this is the biggest move they've ever seen in treasuries and whatever. Well, that's because we had thin markets and very thin hours where we had extremes. Then the market comes into our own time zone. You populate that with much more trading. Here's the only thing that I look at. I like to keep it simple, folks, and let's keep the emotions down. The high yield close for the year in 2s, okay, that was at 438 on the 13th of January. So that, we could see, has a flight to quality, flight to safety feature built in, maybe a Fed component built in. Now, let's go up the curve. On the 14th of January, a 10-year closed at 479. A 30-year closed at 498. Those closing yields are above where we're at now. So if the world is so bad and treasuries are expressing everything's on fire, why can't we get a higher yield close on the year versus where we were in January? Those are numbers we should pay attention to.
Sorry it was so long, but do you get it? The ending part of that, I hope you guys stayed along for all that. So here's with all this great news. We have inflation plummeting. We have the tariff, having everybody's hair on fire. But let's get over to some of the things that the economy looks at. Are we going into a recession, stagflation, all those numbers? Let's just look at the data that we have. That's all I want to say. So you can, bash me down below or whatever. Let's just look at the data. So we're going to go to ADP payroll. Okay, I don't really like their numbers a lot of times, but it's the most used numbers that we have in most cases. So the ADP payroll numbers came in last time, and the private payrolls added 155,000 in March. Okay, and you go down through here, and here's the job gains throughout the economy and throughout the years. We're going to go through here. It was decimated right in this area here where we had COVID, but then we came back through, and we basically equaled out here, and it looks like the job growth is continuing to go. Okay, so there doesn't look like the economy completely slammed the brakes on everything there. You look over through here as well, and there was a chart up here just for a second ago, but I'll go back to that. Then we go over to the disposable income. How much extra income do people have? Everybody continues to say, well, everybody has way too much credit cards. The world's too much leveraged. Well, let's look right behind me right now. This is how much disposable income people have had. And I, had a lot of debates with people in the past. They're like, you keep saying, inflation was created during COVID because people had too much money. That's a farce. Well, unfortunately, I can prove it basically through here to a point. Okay, so here's the disposable income chart throughout our history. It goes back to kind of when I was born. I was born in 1965. So our parents, they would try to save throughout the years, and then we became parents and we tried to, get our education and work 2-3 jobs, and you guys are doing the same thing. Then we go up through here. And then all of a sudden, look at that phenomenon. What is that? It's a complete, out of the ordinary. Think of Sesame Street. Going through here, where does that fit out of the ordinary? Right through here. Well, what is that time frame? 2020, well, the end of 2019 and the end of 2021. What was that? COVID. Okay. People had more money than they've ever had in history. Okay. So that's what we're seeing right now. They're basically exceeded it now. So people have more money now than they did in COVID because of savings, the stock market and everything else. Well, other than 2-3 weeks ago. Okay. So that's what we're seeing through here. So we have job stability or job growth still going into the market with the ADP payroll numbers, and those numbers continually go. And then we also have disposable incomes there. We have also the money supply. You can see right through here, the M2 money supply. The Federal Reserve sucked some of this money out, but then some of the money came back in. So the money supply isn't skyrocketing like we saw during COVID and so forth. It's been basically just stagnant, or there's probably less out there now than at the end of at its peak. So a lot of this is telling me, and we're not going to say, you know, the world's not ending, but it's not. Okay, so let's just assume this. Let's assume the tariffs aren't going to be hugely inflationary. You have the CPI, which came into this week, that is lower than expected, lower than analysts expected. You had the PPI, the producer inflation, that came in lower than expected, and we only now have even lower energy costs. So is it even going to go down further? Then we had if you watched this morning's interview, we watched a video of a current Fed official, and they're saying even housing equivalent rents has now turned negative, and that's 40% of the consumer inflation numbers. So you're having inflation coming down probably very soon, right at the trigger point of where the Federal Reserve wanted it. So now, how's tariffs going to play a role in this? Nobody knows. And people keep analyzing, and that's all you hear on news after news. They're all trying to estimate and guess what's going to transpire. I'm just saying, if this washes out, and it will eventually, I think, you know, if you hear settlements from China, you're going to see a complete reversal of all this stuff. And I think that a lot of the bond markets are being manipulated as well too. So I'm not locking in any of my clients right now. That could pay off. If you want me to lock you, I will. But right now, you know, if you're out there looking to buy a house, love to help you and help you navigate this environment. Because our slogan here for those newbies out there is one application, one credit pool. We're going to shop your loan over 30 different lenders. Now, how do we do that? Well, my name is Dan Frio. I'm actually a mortgage loan officer. I'm licensed in all 50 states as well as Puerto Rico. I actually work at a federal bank, believe it or not. So yes, I'm a loan officer, and yes, I work at a bank, but we're also set up with 33 other lenders. These are mortgage companies and other lenders. Why do we do that? We want to offer you all the programs we can. So one application is therateupdate.com. I will be your loan officer through this whole process. If you're looking to buy that first house, buy that first investment property, maybe you're looking to refinance. You should have done that 2-3 weeks ago. Go back to my videos back then. I was telling everybody to lock in because this might happen, and it happened. So that's it. If you want to reach out to us, I'd love to work with you. And go to therateupdate.com. Right over my head, you can put in your application. Right over there, we just revamped our calendar, so check that out. You can schedule a consultation with me. You can even give us a call right through there. But if you're a first-time home buyer, scroll down to the bottom of the videos right through here. You're going to see a video here that you might be really interested in. It's going to walk you basically from credit application to keys in your pocket. But if you're a current homeowner and you're like, okay, Dan, I watch all the time and I'm just waiting for these rates to come back again. I'll pull the trigger. I promise I'll pull the trigger this time they come down. Well, put in your information right through here. This is our rate watch. What you're going to do is just click it. You're a homeowner. Just tell us what what kind of mortgage you have now, what the rate is, what's your home value. We won't sell the data. It's just for our use. And when that number hits what you want on the number to refinance, I'll give you a call, text, and an email, get you on the phone, get the application started, and make sure you're saving money and don't miss the next little downturn in rates. So thanks for watching, folks. God bless. Have a fantastic weekend. I will do a event this weekend, Stock Talk, because I want you guys to understand what's going on in the market. We're going to do a search based on, the market's down now 3,000-4,000 points. Let's start looking out there and see what investments are out there that might be something to look at. So thanks for watching, guys. God bless. Take care. See you tomorrow. Bye-bye.